Most people think the biggest barrier to property investing is the deposit. They assume you need hundreds of thousands of dollars saved before you can even consider buying an investment property. But after working with hundreds of first-time investors, I've noticed something interesting. The deposit is usually not the real roadblock. In fact, many people who think they're years away from investing are actually much closer than they realize. Because there are really only three numbers that determine whether you can start investing in property. The first one is obvious. The second one, most people eventually figure out, but the third one is the one that quietly stops investors before they ever really get started. And almost nobody thinks about it until it's already too late. Once you understand these three numbers, you can usually tell very quickly whether you're ready to begin or exactly what needs to change in order to get there. Those three numbers are simple: your deposit, your ability to hold the property, and your borrowing capacity. Now, most people assume the deposit is the hardest part, so let's start there. Because the amount of money people think they need to begin investing is usually very different from the amount they actually need. Imagine you're looking at an investment property around the 600K mark, which is a pretty typical point in many markets investors buy. Most people assume you would need a full 20% deposit to purchase something like that, which would mean saving about $120,000 before you could even begin. For many people, that assumption alone pushes the idea of investing years into the future. But here's the reality. In Australia, many investors start somewhere between 10 and 20% deposit. Using that same $600,000 example, a 10 to 12% deposit means you're looking at roughly $60,000 to $75,000 as the initial contribution. Now, on top of that, you still need to account for purchase costs, things like stamp duty, legal fees, and inspections. But the key point is this: you don't necessarily need to wait until you have a perfect 20% deposit before you can begin. In fact, many investors start anywhere from around $80,000 to $100,000 in savings. And that deposit doesn't always come entirely from cash savings. Sometimes part of it comes from equity. For example, someone might already own their home, and over the years, the value of that property has increased. That increase in value can sometimes be used as equity to help fund the deposit for an investment property. So instead of waiting years to save every single dollar in cash, investors are often combining savings with equity to enter the market sooner. Interestingly, there's a bit of a sweet spot many investors land on, around 12% deposit. It's large enough that the lender's mortgage insurance, or LMI, is manageable, but it doesn't require waiting several extra years just to reach the full 20%. This is where many people get stuck. They wait until they feel completely comfortable with their deposit, but the property markets don't wait for comfort. They reward participation. And once people realize the deposit might not be as big as a barrier as they thought initially, the next question usually becomes very clear. Can I actually afford to hold the property once I buy it? Because buying the property is only the first step. Holding it long enough for it to grow is what actually really determines whether the investment works. So factor number two, holding the property. The second number that actually matters is whether you can afford to hold the property. And this is where a lot of first-time investors get surprised. Many people assume a good investment property should completely pay for itself. The rent should cover the mortgage. The expenses should be taken care of. And the property should simply sit and just generate you income. But most growth-focused investment properties don't actually work that way. Properties that are positioned for strong long-term capital growth usually generate yields somewhere around 4 to 5%, which means the rent you receive doesn't always cover every expense perfectly. So let's walk through a really simple example of what this might look like. Imagine you purchase again a property for $600,000. Let's say that the property rents for $500, $550 a week, which works out to be roughly $28,000 a year in rental income. From that income, you still have several costs to cover. The biggest one is usually the interest on the loan, depending on the loan size and the interest rate. That might be around $30,000 a year. Then you have property management fees, maintenance fees, insurance, council rate. Let's say those additional costs total anywhere from $8,000 to $10,000 a year. When you add everything together, the property might generate you $28,000 to $30,000 a year in rent, but might cost you $38,000 to $40,000 a year to hold, which means you're contributing anywhere from $10,000 to $15,000 a year out of pocket to keep the property. This is where many people misinterpret what a good investment actually looks like. Some investors see that $10,000 cost and immediately assume this investment is no good. But the real question is not whether the property costs you to hold. The real question is, what is the asset doing over time? If that same property grows in value $60,000, $80,000, $100,000 in a year, the bigger picture starts to look very different. That's why experienced investors don't just look at cash flow. They look at the combination of growth, equity, and long-term opportunity. Holding the property is simply the price of staying in the game long enough for the asset to perform. And once someone understands the deposit and the holding costs, the final number becomes the one that quietly determines how far an investing journey can actually go. Because the real limitation for many investors isn't the deposit, it isn't even the holding costs, it's the borrowing capacity. The third number, and often the most important one, is the borrowing capacity. Property investing isn't just about buying one property. It's about what that first property allows you to do next. Borrowing capacity is essentially how much the bank is willing to lend based on your income, your debts, and your overall financial position. This is where many investors unknowingly hit their biggest limitation. They might have the deposit. They might be comfortable with the holding costs, but their borrowing capacity only allows them to purchase one or two properties before they reach a ceiling. Once that happens, the portfolio stops growing. Understanding borrowing capacity early is incredibly important because the way your loans are structured, your income position, and even how you purchase your properties can influence how far your investing journey can actually go. Some investors never run into this issue. Others only discover it once they've already reached their limit. And by that point, it can be a much harder thing to adjust. So while the deposit gets most of the attention and holding costs are often the biggest concern at the beginning, borrowing capacity is usually the number that quietly determines how far an investing journey can actually go. Let's bring these three numbers together with a simple example. Imagine a couple earning a combined income of around $110,000 a year. They've managed to save around $100,000 for a deposit, and they're looking for an investment property around $600,000. Based on that deposit, they're able to enter the market without waiting several more years to save a full 20%. They understand that holding the property might cost them around $10,000 a year out of pocket, and when they speak to their broker, they confirm their borrowing capacity allows them to purchase the property comfortably. At that point, the numbers start to line up. They have the deposit, they can afford the holding costs, and their borrowing capacity allows them to move forward. Now, will the numbers look slightly different for every person? Of course, income matters, existing debt matters, family circumstances matter, but the broader pattern is surprisingly very, very consistent. At Fresh Start Advisory alone, we've helped more than 800 people buy investment properties using this exact approach. Most investors who successfully started investing didn't feel completely ready when they began. They simply realized the numbers already work. Once those three numbers start to line up, the decisions become much, much clearer. Starting isn't about having perfect finances. It's about having the right pieces in place. Now, to be fair, not everyone watching this will be ready to invest yet. If you don't have a deposit save, if your income's unstable, or if your finances are stretched to the point where even small changes will create stress, then waiting and strengthening your position first is usually always the right move. Property investing works best when it's sustainable. You want to be able to hold the property comfortably, not feel like you're constantly under pressure. But what many people discover when they actually run the numbers is that they're often closer than they initially thought. Because the barrier to entry isn't perfection. It's simply having those three numbers working together, the deposit, the ability to hold the property, and the borrowing capacity to make the purchase possible. When those three numbers line up, the starting point often appears much sooner than people expect. And that's why many investors realize the biggest obstacle wasn't necessarily the money. It was simply understanding how the numbers actually work. But once people realize that they can start, the next question becomes even more important. What should you actually buy first? Because choosing the wrong first property can quietly stall your investing journey before it even really begins. So, in the next video, we'll walk you through exactly how to choose an investment property without guessing and the mistakes that cause many first-time investors to get stuck. If you're serious about investing, that's the one I'd recommend watching next. Video will be floating around somewhere on this screen. Just click on it, and as always, to your success.